So we discussed in the last lecture exemption under section 54F. Till 54F, how many deductions we have discussed? We have discussed six exemptions, no deduction, exemptions. Exemption under section 54, 54B, 54D, 54EC, 54EE and 54D. So now I am starting with my seventh exemption, 54G. So let me share the screen and let us start discussing exemption under section 54G. So let us start discussing remaining exemptions. Let us discuss the remaining exemptions now. Seventh exemption, 16.7. Exemption under section 54G. When you shifting of industrial undertaking from urban area. Whenever you shift your industry from any urban area, now so many times as a businessman you might not be interested in shifting your factory from one area, any area in which your factory is already there, you are not interested in shifting that factory. But so many times government regulations make it mandatory that you shift your factory from urban area. It may be because of noise pollution, air pollution. Around 15 to 17 years ago, because of the heavy pollution in Delhi, so many industries were compulsorily shifted from some areas of Delhi. That is why some industries moved towards nearby areas in Haryana, Rajasthan, UP. So because of so many times situation arises when you have no option but to move your factory from urban area. How can you move? Now it is not a movable property. if I am having a factory in Delhi, suppose I'm having a factory in Delhi, I will sell land. If I want to move this factory from Delhi, because Delhi is an urban area, it's a municipality, urban area. If I want to shift to, for example, in Alwar, Rajasthan, which is around 150 kilometers away from Delhi, if I want to move my factory in Delhi from Delhi to Rajasthan, for example, Alwar is a city in Rajasthan, there I want to move my factory. How can I move? I will sell the land here. I will sell the building here. I will sell the plant and machineries which are installed in my factory here, and then I will purchase new land there, new building there, might be new plant and machineries. That means my real intention was not to sell this factory. When I will sell these things, I might earn some capital gain. Land is a capital asset, building is a capital asset, plant and machine is a capital asset. So when you sell capital asset, you have to compute your income under the head capital gains. So I will earn some capital gain, or in fact, it is possible that I might earn heavy capital gain when I sell my industrial undertaking in urban area. But I'm not selling it for the purpose of selling. I have to sell it because I want to establish new factory in a different area. So in these cases, government says that your capital gain can be tax free or can be exempt under section 54G if you purchase another land, another building, another plant and machinery which you will use for industrial purpose. So main intention of the assessee is what? Not to sell these things. Assessee has no option but to sell this thing. He is shifting his factory from urban area to any other area, to another area. How shifting will be done? It will be done only when you sell the assets. So when I am selling the assets, there can be a capital gain. But whatever I will invest in another land, another building, another plant and machineries within the eligible time limit, then that investment I can deduct as exemption under section 54G. That's it. So I wanted to only tell you some basic of 54G. Remaining you have to self-study from the act. I wanted to give you an idea about 54G that I have given. Now you read from the website or Income Tax Act 1961 this section 54G yourself. That's it. Next point, 54H, and that is my last exemption, 54H. In fact, 54H is not an exemption. It talks about something different. 54H talks about some extension of eligible time limits. In case of transfer of capital asset by compulsory acquisition. When government acquires your capital assets compulsory under compulsory acquisition, in that case there might be some delay in in receiving the amount from the government. There might be some delay in receiving the compensation amount. When you actually sell it to any party, you will get the amount on the spot. But when government has compulsorily acquired your assets, government might delay the compensation amount. Now, if government delays the amount, how can you invest until unless you receive the amount? Just like, for example, if you take a simple example of section 54, when you are selling a residential house, if you take a simple example of section 54, when you are selling a residential house, if you remember the example, I sold a residential house on 10 December 2020. Suppose that was not my sale intentionally. I didn't want to sell the house, but government acquired it compulsory. Government made compulsory acquisition. So when government made compulsory acquisition indirectly, I sold it. Whether I sell it by my own choice or government has compulsorily taken my house. Suppose Delhi Metro is going on and for that purpose my house is required to be demolished by Delhi Metro, so they acquired compulsory. I had no option in that case. Whenever it is public purpose, then as an individual, I have no option. Government has a right to take my house compulsory because it is coming as a hindrance for the public growth or public benefit. For Delhi Metro, there are so many land and buildings there were so many lands and buildings which were compulsory acquired by the government, and people had no option, like in flyovers, dams, highways. In these things, land will be compulsory acquired or house will be compulsory acquired. Now suppose my residential house was compulsory acquired by the government. Indirectly, I have sold the house indirectly. But that sale is through compulsory acquisition on 10 December 20. And suppose I earned a long-term capital gain of 17 lakh. Now if I want the exemption, I need to purchase another house within 2 years. Or if I want to construct another house, I have within 3 years. For purchase, 1 year before is also covered. But government delayed the compensation amount. I have not received the compensation. For 3 years, I haven't received the compensation. Section 54H extends my time limits. In case there is any delay in receiving the compensation amount, then you cannot impose those conditions which are there in section 54F. Like 54F says that I should purchase the house within 1 year before or within 2 years after. And suppose I don't receive the compensation for 4 years. Then in that case, it was not my fault. I couldn't purchase the house because I didn't got the compensation. Section 54H deals with these circumstances. Section 54H extends the eligible time limits in different exemption sections. In different sections of exemptions like 54, 54B, etc. In all these exemption sections, there can be a transfer because of compulsory acquisition. So I can apply 54H in almost all earlier exempted sections which deals with capital gain exemptions. This is practically not a separate exemption. 54H only provides a helping hand to the assessee to get the exemption under different earlier sections of capital gain. It only extends my time limit. This also I'm giving for self-study. only wanted to give you an idea. And now open the act and read 54H yourself. This is also a self-study section, so that you get to know about the idea how the language of Income Tax Act is generally written, or any act is written. So these two are for self-study for today's class, 54G and 54H. Now with this, almost my 80% topic of capital gain relevant for BCom Honors Semester 3 is over. Complete. The moment you read this 54H, then you can say that your 80% capital gain semester 3 is over. Almost all the calculations of capital gain are over, and now I am starting with a new concept, how to compute tax on capital gain. So this is my new concept, heading 7, how to compute tax on LTCG. It is my new heading. So calculation of income is almost over. Now you can easily compute the income under the head capital gain. How to compute the tax? That is another question now. Can you tell me LTCG is taxed at what rate? Can you tell me LTCG is taxed at what rate?
So 20%.
Under which section? %20 under which section? Section 112. Any other tax rate?
So 10% exempt up to 1,112A.
It is taxed at 10% over and above 1 lakh, and it is section 112A. That's it. These are only the two sections which deal with computation of tax. So I'm using the word computing tax. Can you tell me how I compute LTCG? Tax rate you have told me, no problem. How do we compute LTCG? Can you tell me how do we compute LTCG? How do we compute LTCG? Any answer?
Sale consideration less expenses less indexed cost of acquisition less indexed cost of improvement.
Yeah, so LTCG is calculated as per which section? 48. So my calculation of LTCG depends on section 48, but once I go to LTCG, then I will apply section 112 for computing tax rate. This is one thing. I'm computing LTCG as per section 48, but on that LTCG, I will apply 20%. That is not written in section 48, that is written in section 112. Is this thing clear? If yes, please raise your hands. Next point. So now I am bifurcating this discussion in two different topics. First, I will discuss with you section 112, and then I will discuss with you section 112A. So now I am making a separate heading. I'm saying now that section, not section, this is my 17th heading. I have prepared those headings so that you can easily relate these with the numbers. It is my 17th heading, tax on LTCG under section 112, or you can say other than the LTCG under section 112A. Both these two sections are different. Right now I'm talking about tax on LTCG under section 112. That means section 112A LTCG is not covered here. I hope this point is clear. So now let me start discussing the concept. First point, you compute LTCG as per section 48. If you have to compute LTCG, then you will use section 48, where sale less expense on sale minus indexed cost of acquisition minus indexed cost of improvement. And then tax rate is to be applied as per section 112. But some relief is available. Some relief is available. Relief available from LTCG under section 112, which is taxable as per section 112. As per section 112, some relief is available. What is that relief? That I will explain to you with the help of a numerical. So this relief I will explain. Third point, from LTCG, deductions of section 80 are not available. No deductions, that I have already explained to you. Under section 80 is allowed from long-term capital gain. If I'm talking about long-term capital gain, that means I'm talking about that gain which is taxable as per section 102. 112A is altogether a different concept. So if I'm talking about section 112, by default you must be having one clarity in your mind, that these provisions are not applicable for LTCG, which is taxable as per section 112A. It is that which is taxable as per section 112. That first you compute LTCG as per section 48 and then you apply the tax rate as per 112. Before applying the tax rate, some relief is available, some benefit is available. Third, you cannot give any deduction under section 80 from this long-term capital gain. And fourth, in some cases, under section 112 itself, LTCG is taxable at 10%, not 20, at 10%, as per the option of the assessee. But it is not compulsory. Assessee has the right to take a decision whether assessee want to get taxed at 20% or 10%. These four main points you should not forget in section 112 when you compute the tax rate under section 112 on LTCG. That calculation depends on section 48, tax rate depends on 112. Before applying tax rate, whatever LTCG I have computed as per section 48, that can be reduced if I satisfy the conditions of relief. From this LTCG, you cannot give any deduction under section 80. That is the point which must not be forgotten. And in some cases, I have the option of computing the tax on LTCG at the rate of 10% only, and it depends upon the choice of mine. Do I want to get taxed at 10% or 20% on LTCG? Because if it is 10%, then calculation of LTCG becomes different. If it is 10%, then calculation of LTCG is different. I hope you have not understood these points. So better I should start with a numerical. Only then you will relate these 4 different subheadings of this main heading LTCG taxable as per section 112. So let me discuss a small numerical from my book. Page 7.44. Just see this illustration, not illustration, example. I will read this example for you. X 49 years, a resident individual, X age 49, resident individual has taxable, the word used is taxable LTCG. Taxable means after any exemption of 54, 54F, whatever, etc. It is final taxable LTCG 3,50,000, and it is from the sale of house property during the previous year 2021. So this is on sale of house property. House, on sale of house, it is the LTCG. Then question says, it is to be noted that the long-term capital gain from sale of a house property is not covered under section 112A. Yes, that we must know, and that you will know after I will discuss with you section 112A. Section 112A covers equity shares or units of a equity oriented fund. That's it. To be very precise or to be very specific for your level, you must remember that section 112A deals with the capital gains on sale of equity shares only. Right now I am selling the house, so it cannot be covered in 112A. So if it cannot be covered in 112A, I have only one another section left, which is section 112. So I will compute the tax rate as per 20% or 10%. That provision I will tell you now. But one thing is sure, that this LTCG is not covered under 112A because I am selling the house. 112A for your level covers only equity shares. That's it. So this is to be taxed as per 112. At what rate? 112 gives you the rate of 20%. In some cases, the rate of 10% is also available. That I will see. Second, what you need to check, will you tax entire 350 or some relief will be available from 350? These 2 points need to be remembered in section 112. That's it. Otherwise, there is nothing in 112. Only flat 20%. The points which you need to remember while you compute the tax under section 112 is that whatever is the LTCG, can you claim some relief from this 3,50,000 LTCG? Second, will you apply the tax rate of 20% or 10%? These 2 provisions you need to know. Now let me read the question, remaining question. His income from other sources is 60,000 during the previous year, 2021. My IFOS is 60. And compute his tax liability. Question is saying that compute his tax liability for the assessment year 21-22 on the assumption that he has deposited 10,000 in his own PPF account. So when I deposit 10,000 in my own PPF account, deduction under section 80C, I will get 80C. Amount deposited is 10,000 rupees. That's it. This is what the question. Question is not saying anything about 112 LTCG extra. They simply says compute tax. Now let us start computing tax. So what is my solution? I should proceed how? First I will compute income. Computation of total income of X for the assessment year 21-22. LTCG, how much? 350 plus IFOS 60, gross total income 410 less 80C, 10,000. This is my total income, 4 lakh. Till this point, if you have 100% clarity, please raise your hands. Till this point, in case there is no issue, please raise. Next point. Now let us start computing the tax. Let us start computing the tax. So how do you compute the tax? So I am writing it on the or here itself. Tax or next page. Let me write it here. Simple point is I need to compute tax on 4 lakh rupees. But I need to always check, is there any special income included in this total income? Yes. The special incomes are lottery income, which are taxed at flat rate of 30%, short-term capital gain under section 111A, which is taxed at a flat rate of 15%, and long-term capital gain under section 112A, which is taxed at 10%, and remaining long-term capital gain is taxed at 20%. Section 112. So what are special incomes? Now, this is not for you to note it down, but you must remember what are special incomes. Lottery, flat rate 30. Short-term capital gain, section 111A, flat rate 15. Long-term capital gain 112A, flat rate 10. Remaining long-term capital gain, remaining LTCG 112, flat rate 20 or 10. 20 or 10 that you need to see. These are the special incomes. And when I went to apply the tax on 4 lakh, I found that there is a special LTCG of 3 lakh 50. Since section 112A is not written and it is not a 112A, then 350 should be taxed as per the provisions either at 20% or 10%. Now let me, before discussing this question, let me first tell you that 10% provision. So I want to now tell you this fourth heading. What are those cases where LTCG at 10% is applicable? So what are those cases? So you must leave around 20 lines blank. 20 or at least 18 to 20 lines you should leave if you have started attempting this question, and then you should write somewhere some points to be noted. So my point number 1, option of 10% LTCG, option of 10% tax on LTCG. Under section 112, option of 10% tax. What is that option? It is in case of listed securities. So conditions when you can pay at 10%. You must be a resident. First point, resident. Second point, gain is long-term capital gain other than which LTCG? Can you tell me other than which LTCG? Other than the LTCG which is covered under section 112A. Other than this LTCG. The capital asset is listed security other than units. That means other than mutual fund industry, other than the units of mutual fund, listed security. These can be listed. What do you mean by listed security? There can be listed shares, listed debentures, etc. And fourth is indexation is not done. Indexation is not done while computing LTCG. Indexation is not done while computing LTCG. This is my note number 1. Under section 112, tax rate on LTCG is 20%, but in this situation, you have an option. You can also compute 10%. The option is if you are a resident, if you have LTCG other than 112A. In this case, I am a resident. In this case, I have my LTCG other than 112A. Is your capital asset a listed security? No. For 10%, you have the option to apply 10% only when you are selling listed securities or listed shares or listed debentures. But now I am selling house, so I'm not fulfilling condition number 3. If I'm not fulfilling condition number 3, then one thing is sure that in my example, there is no 10% option available. I have to apply flat 20% tax on LTCG. I have to apply flat 20% tax on LTCG. So I removed this possibility from your mind that in this case we have 10% option. No, we don't have 10% option. We have only one option, which is flat 20%. So I discussed with you my last condition. When I wanted to discuss with you 112, I discussed with you this condition. It's over now. Third condition is very simple, that you cannot give any deduction under section 80 from LTCG. Condition number 1 doesn't require any discussion. And now let me discuss condition number 2 also. Relief available from LTCG. The moment I discuss with you relief available under LTCG, then you can compute tax on any LTCG which is covered under section 112. So now discussion on point number 2. Relief from LTCG under section 112. What is this relief? If you want to claim this relief, first of all, you must satisfy these two conditions. First, you must be a resident individual. Or resident HUF. This is first condition. Second, your total income excluding this LTCG, which is taxable as per section 112, must be less than exemption limit of the assessee. That's it. That's it. Your total income excluding this LTCG is less than the exemption limit. For example, my LTCG, in my example, my LTCG is 3,50,000. My total income is 4 lakh. Can you tell me how much is the total income excluding LTCG? How much is the total income excluding LTCG?
50,000.
50,000. So in my example, what is happening? My total income excluding LTCG is 50. Is it less than my exemption limit? Yes, because my age is 49 years and I am a resident. So what is my exemption limit? Till how much amount of income I am not supposed to pay any tax? Up to 2,50,000. This is my exemption limit. So is my total income excluding LTCG less than my exemption limit? In my question, yes. If yes, then you will get relief. So how much will be the relief amount for you? How much will be relief? Relief from such LTCG will be exemption limit minus total income excluding this LTCG, excluding such LTCG. This is my relief. My relief in my example is 2,50,000 minus total income excluding 50, 2 lakh rupees. So that means I will not pay the tax on 3,50,000. From 3,50,000, I will deduct 2 lakh rupees and I will pay the tax only on 1,50,000. This is the benefit of relief under section 102. Practically what the concept wants to say, that whatever is your LTCG, for example 3,50,000 in my case, and what is your total income excluding this LTCG? My total income excluding this LTCG is 50,000. So even if I add 2 lakh in this total income, it will still be rupees 250, which is still not taxable. When my total income excluding LTCG is 50,000, it is not taxed because up to 2,50,000 it is tax free. So government says you can shift that much of difference from this LTCG. That means I can remove my 2 lakh from here and I can shift there. There the effect remains still the same, which was there when the total income was 50,000. But you will get some positive. Your taxable LTCG now becomes 1,50,000. That's it. When I am doing this question, I have computed total income. And now how will I compute the tax? I computed the total income. Now how I will compute the tax? When you say computation of tax liability of X for the assessment year 2021-22, how will you compute the tax? You will apply the relief concept first, and when you applied the relief, what you found? That you are a resident, your total income excluding LTCG is 50,000 and it is less than your exemption limit 2,50,000. By how much it is less? It is less by 2 lakh rupees. This 2 lakh is nothing but relief. That's it. So your relief is nothing. I'm writing 2,50,000 exemption limit minus this 50. So this difference is relief. So when you will compute tax on 3 lakh rupees, you will say that tax on only 1,50,000 is charged, because whatever was my 3 lakh, as per the provisions of the Act, I am entitled for rupees 2 lakh relief, and now only on this difference amount 1,50,000 I will pay the tax at the rate of flat 20%. The section is 112 and it becomes 30,000. So I checked always for LTCG taxability, always check this relief point, always. And similarly, always check this 10% option. Since in this case I was selling house, 10% option was not available to me. This is my tax on LTCG, which is 30,000 plus tax on other income. Nil. There is no tax on other income because total income was 4 lakh and I taxed this amount. Indirectly up to 3 lakh I taxed. Not 3 lakh, indirectly up to 3 lakh 50,000 I taxed. This is 3 lakh 50. So remaining 50, tax is 0. This is the tax. That's it. Now, will you get any rebate under section 87A? Yes. How much is the rebate under section 87A? 100% of tax, which is 30,000, or 12,500, whichever is less. So 12,500 is less. And I'm entitled for this relief because my total income does not exceed 5 lakh rupees. My total income is only 4 lakh. So this is the balance. 17,500, and you only add cess at the rate of 4%. 17,500 into 4%, 700 rupees. And this is the tax which you will pay to the government of India. 18,200 rupees. That's it. Please raise your hand if this point is clear. Now you can easily attempt all the numericals where you have to simply compute tax liability and wherever LTCG under section 112A question comes. I have not yet discussed section 112A. I have discussed only section 112 for the time being. Do remember, first thing, is assessee entitled for any relief, and second thing, is there any option available or not? If this point is clear, so let me give you one question for you to solve. You please try to solve this numerical. I will give you 5 minutes to solve. Try to solve this numerical from my book. I'm giving this numerical for you to solve. It is on page 7.45. Example. Try to get the answer of this numerical. It is, so let me tell you, why 35 years a resident individual, so age is 35, resident individual has long-term capital gain 3 lakh from sale of gold. So gold was sold and LTCG was 3 lakh. During the previous year 2021, it is to be noted that long-term capital gain from sale of gold is not covered under section 112A. Yes, I know, because section 112A covers only equity shares. Gold is not covered in section 112A. His income from other sources 2,80,000. IFOS 2,80,000 during the previous year 2021. Compute the tax liability for the assessment year 21-22 on the assumption that he has deposited 50,000 in his PPF account. So practically his gross total income is 580. And suppose he has deposited 50,000 in his PPF account. So this 50 is 80C and total income is 5,30,000. Now try to tell me the answer of tax. That's it. I need the final answer of tax. How much tax I will pay to the government of India? I'm giving you 5 minutes. Try to solve it. In case you have any problem, you can ask me, but you please try to solve it.
So 58240.
58240 is the correct answer. Let others also try, and let others also try to see whether. Let others also try. 58240 is the answer. Carefully, you have to apply the concept of relief. Here also, option of 10% is not available because gold is sold, not a listed security. So answer is 58240. Try to get it. If it is taking time, take. So I'm giving you 4 more minutes. Try to get the answer. Those who have got the answer, they can raise the hands. If you got the answer, that means you have learned the concept of computing relief correctly. Others, please continue trying.
Sir, you are on mute.
Okay, so you please raise your hands if you want me to proceed further. Okay, now let me discuss one question where shares are sold. Let me discuss one question where shares are sold so that I will explain to you the concept of that 10% option. So another illustration now. So let me discuss that concept with the help of another illustration from my book. Page 7.47. Another example. X 39 years. X 39 years. Again, a resident individual sold 1000 equity shares on 10th December 2020. He sold 1000 equity shares on 10th December 20. So 10th December 20 is in my previous year. 10th December 20. For rupees 4,02,000. The sale value is 4,02,000. And also paid STT at the time of sale. He also paid STT at the time of sale. Can you tell me what is this STT? Securities Transaction Tax. This is STT. If it is paid, it means now when STT is paid for your level, you must remember that whenever listed for your level only, otherwise in options also we pay STT, but for becoming semester 3 level, whenever listed equity shares are sold, STT is paid by default at very small percentage by the seller as well as by the purchaser. Both the people have to pay very small percentage of sale as security transaction tax when listed shares are sold. Where these are sold? In recognized stock exchange in India. Listed shares can also be sold. Listed shares can also be sold outside recognized stock exchange in India. In that case, you don't pay STT. So just because STT is paid, it does not mean that no. Just because listed shares are sold, it does not mean that STT is by default paid. You have to carefully check whether equity shares are sold in a recognized stock exchange or outside. If listed equity shares off market transactions are also done, I can sell directly to my friend without going to the stock exchange, but shares can be listed. If outside recognized stock exchange in India, if the transactions are sold, then STT is not paid. And by default, I can say that one thing is sure, whenever unlisted equity shares are sold, STT can never be paid, because only in stock exchange only listed shares are traded. Whenever unlisted equity shares are sold, STT is not paid. Is this point clear? For the timing, I am restricting my discussion to only equity shares. If listed, then if in a recognized stock exchange, that means STT is must. If outside stock exchange, STT is not required. If unlisted equity shares, by default, STT is not paid. Is this point clear? If yes, please raise your hands. Please raise your hand if this point is clear. Now in my question, what is happening? What is happening in my question? Age 39 years, resident individual sold 1000 equity shares on 10 December 20 for 4,02,000 and he paid STT at the time of sale by default. Can you tell me the interpretation or conclusion from this point? If STT is paid, by default, I can say that these equity shares are listed and sold where? sold in a if STT is paid by default, these shares are listed and these are sold in stock exchange in India. Of course, it will happen. Only then STT is paid. This is one thing. So I'm continuing this discussion on this point there here. Next thing what is happening is however, when these were acquired on 6th May 13, what was the purchase date of these shares? These were purchased on 6th May 2013 for rupees 2,20,000. At that time, STT was not paid. At that time, STT was not paid. So can you tell me what would have happened on 6th May 20 when STT was not paid? Either these shares were unlisted at that time, or shares might be listed, but I purchased from here. I purchased from where? From outside stock exchange. Any of these two possibilities could have happened on 6 May 2013. I hope you agree with me. Right now, these might be listed, but maybe around 8 years ago when I purchased, these were unlisted. That is why STT was not paid. Or these might be listed at that time, but I traded or I purchased these from outside stock exchange, so STT was not paid. Any of these two possibilities could have or could be there. Compute his total income and tax liability on the assumption for the assessment year 21-22, assuming his income from other sources during the previous year is 3,59,000. IFOS is 3,59,000. CIA for 13-14, cost inflation index for 13-14 is given, which is 220, and cost inflation index for 2020-21 is given, which is 301. Now let us start solving this question. Ignore the taxability. For the timing, let us compute the tax first. Let us compute the total income first. So I'm coming to the next page. Computation of total income. How much is LTCG? Sale value is 4,02,000. Now you tell me, is it long term or short term? This is my question to you. Is this long term or short term? In my example, this is a long term capital asset or short term? Can you tell me?
Long term.
How?
So we check the name of the asset, which is listed shares, and then we check the holding period from 6 May 2013 to 10 December 2020. That's way above 12 months. So we can conclude that.
Not to 10 December. One
9
day
December.
before. And that is above how many months?
12 months.
Yes, listed shares. I'm selling listed shares, so the period is more than 12 months. So this is long term sure. So do indexation. If it is long term, I will do indexation. There is no expense on sale, but how much is index cost of acquisition? 2 lakh. For 2 lakh, the shares were purchased divided by the index of 13-14. May 13 is in 13-14, which is 220. and multiplied by the index of current year, which is 301. So my index cost of acquisition is this cost of purchase given in the question is not 2 lakh, it is 2 lakh 20. Okay, so make this change. This cost is 2 lakh 20. I purchased this for 2 lakh 20. So 220 divided by 2 lakh 20 divided by 220 multiplied by 301. It is 3 lakh 1000. Minus 402. 1 lakh 1000 is my LTCG. This is one thing. So I'm not talking about any tax for the timing. For the timing, I'm simply computing the income. Add. Is there any income from other source? Yes, which is 3 lakh 59. Gross total income 4 lakh 60. Less deductions under section 80C. Not given. So in this question there is no deduction. So I can say there is no deduction of section 80 given. Nil. How much is total income now? 4 lakh 60. Now next question. Since I have not yet read section 112A, for the timing, you know that 112A covers equity shares. Here also we have equity shares. So to make this question simple, let me assume that in the question, let me assume that this case is not covered under 112A. Though after you read 112A, you can easily say that this case is not covered under 112A, but since you have not yet read 112A, let me tell you directly that this case is not covered under section 112A. Let me assume that this case is not covered under section 112A. Since this case is not covered under 112A, now it has become a little bit simple for me. Now I will compute the tax. So compute tax. Now I have to compute tax on 4 lakh 60, but in this 460, is there any special income? Yes. How much is special income? LTCG, which is taxed either at 10% or 20%, because section 112 gives two tax rates, 20% or 10%. 10% is exceptional, comes with some condition. But before tax, first let us compute, is there any relief available? So in working note, what I am computing? First of all, relief. So note number 1, I'm checking about relief availability. How do I check relief availability? First condition, is the assessor resident individual? Yes. Second condition, how much is his total income excluding LTCG? This total income is excluding LTCG is how much? 460 minus 1 lakh 1. It is 3 lakh 59. It should be less than exemption limit, which is not there. Because how much is my exemption limit? 2 lakh 50. Age less than 60. So now total income is not less than exemption limit. So this condition is not fulfilled. So relief not applicable. In this question, there is no relief which is applicable because I cannot fulfill the conditions in this question. Please raise your hand if you have understood that yes, I cannot give any relief in this question. Please raise your hand if you have understood that I cannot give any relief in this question. Next point. Next point. If relief is not available, then what is my note to? Check the option of 20% or 10%, which is better. Now, this is my discussion. I told you for these things, what conditions I need to check. First, I must be a resident individual. Yes, I am. Second is this. Is this LTCG under section 112? Yes. Is this LTCG not covered under 112A? Yes. It is not covered under section 112A. Third, is this capital asset listed security? Yes. These are listed equity shares. And fourth is indexation not done. This is the fourth condition, indexation not done. If yes, then only you can apply 10%. So what I will do now, I fulfill this condition, I fulfill this condition, I fulfill this condition. This condition I can also fulfill if I want. So I will prepare a table, option 1 and option 2. What is my option 1? Simple, 20%. So whatever LTCG I have, 1,01,000. How much LTCG I have? 1,01,000. And how much tax rate I have to apply here? 20%. If I want to go with option number 1. 1,01,000. It is simple. By default, the tax is 20%. But if I want to get taxed at 10%, then I will compute LTCG without indexation as per my condition number 4. So if I don't do indexation, how much is my LTCG? Sale 4 lakh to minus cost directly 220. So my LTCG becomes 1,82,000. And do remember, I told you earlier also, whether my asset is long term or short term, it does not depend whether I will do indexation or not. It depends on the holding period and type of the capital asset. In this case, this asset is a share and it has been held by me for more than 12 months. So LTCG will remain long term, whether you do indexation or not. Indexation is compulsory to be done. But if I want to see this option of 10%, then I have a choice. I can compute also without indexation. If I'm doing without indexation LTCG, if I'm computing this into 10%, it comes out to be 18,200. And which is better? Paying tax at 20% with indexation or paying tax at 10% without indexation? In this case, which option is better? Without indexation. So now I will say that tax on LTCG, which is rupees 1,01,000. In note 2, I have computed the tax is 18,200 rupees. This is what my concept of that 10% option. In case of listed securities without indexation, I can pay at 10%. So always in such questions, whenever I will say listed securities, if it is covered under section 112, I must see carefully that whether paying 20% is better or 10%. The only difference is with 20% I can do indexation. With 10% I cannot do indexation. So you decide accordingly. This is my tax on 1,01,018,200. How much is the tax on remaining income now? How much is the tax on remaining income now? My total income was 460. Out of 460, I have taxed 1,01,000. So I'm left with 3,59,000. From 359, I know that up to 250 there is no tax. So difference is 1,09,000, and the tax rate is 5%. So it will be 5450. So total tax now becomes 23,650 less rebate under section 87A. How much is rebate under section 87A? 100% of tax or 12,500, whichever is less. And since my income does not exceed 5 lakh, I will get the rebate. It is 1,150. Add cess at the rate of 4%. 446. So the total tax is 11,600. Please raise your hand if this point is also clear. It is not technical, it's interesting.
Sir,
Yes.
so when we opt for the 10% taxation rate, won't we have to include 1,82,000 as our LTCG?
No, because in reality my LTCG is 1,01,000. That 182 is only for the purpose of computing tax.
All right, sir. Thank you.
For the purpose of computing total income, my LTCG is flat 1,01,000 with indexation. Without indexation, option is not for the purpose of computing income, only for the purpose of computing tax. In reality, when you compute income, you have to do indexation. Please raise your hand if the point is clear. Don't you think that always 10% option will be better? What do you think? That in case of listed securities, always 10% option is better? Don't you think? Okay.
Might differ according to indexation.
What?
Might differ according to how indexation would work. So like if I'm buying from somewhere around 2000s, then yes, because the value increases 3 times. But if
So
I'm doing,
so I can say that I cannot say that always 10% without indexation is better. I have to see always by solving it numerically, then only I will take a decision. But in some cases, it is always better. Can you tell me those cases where always 10% option is better? Can you think logically? The option of 10% tax on LTCG is always better when listed bonds and debentures are sold. Can you tell me why it is always better?
because indexation is not allowed on their side.
Yes, are sold because in case of listed securities, which are listed bonds and debentures, when you compare the option of 20 and 10, in 10 you cannot do indexation, but in 20, though indexation conceptually is allowed, but in bonds and debentures, indexation otherwise is also not allowed. So here also indexation will not be allowed. So in both the circumstances, indexation will not be allowed. So always by default, 10% will be better in case of listed bonds and debentures. But when listed shares are transferred, then you have to check numerically. When listed shares are transferred, then you have to check numerically which option is better. Please raise your hand if this is clear. This is what my entire section 112 taxability is. Please raise your hand if you have understood the point carefully. Okay, so let us end the discussion here and let us have 15 to 20 minutes break. So I'll be ending the meeting and let us have 15 to 20 minutes break. And at 2:10, we will start with section 112A. That's all for this. Goodbye.